At Grossman, Yanak, and Ford, we really strive to improve and stay on top of current developments. And in all of our disciplines, which has allowed our firm to thrive, over the course of the 27 years that we've been in business. One discipline that's especially complex is taxation. It's hard to believe, but Albert Einstein said the hardest thing in the world to understand is the income tax. And maybe that's because it's just not logical sometimes. I know oftentimes I go back to see Bob about an issue and he tells me the answer and I say, that doesn't make sense. And he says, it just is the way it is. It's the law. So all of the different provisions and the loopholes are particularly difficult to keep track of, but our tax group does a great job. And they're here today, Bob Grossman and Don Johnston, to explain the current status of the legislation, the provisions of the legislation for the, what I think is termed the cut, cut, cut program. So without further ado, we'll let Bob and Don take this subject away.
All right, thank you, John. Good afternoon, everybody. We're going to talk about where the tax reform process is at the current time, and we'll get started in just a moment. I wanted to start this afternoon off with some kind of cutting remark and joke about Mark Wollstonecraft, but I couldn't find one on the internet all morning, so he gets away unscathed this year. But you can bet I'll be spending the next 12 months getting ready for next year. So he better be watching what he's doing. You got that, big guy? Tax reform. What we have is a once-in-a-generation type tax bill before us. And the essence of it is major codification changes within the statutes of the Internal Revenue Code, tons of them. It bodes on you as financial people with your companies and serving other people as advisors to look at the tax law for 2017, these remaining 2 months, as one of 4 major possibilities. I mean, you can plan on nothing happening at the tax law. And that is still a possibility, though I think you'll see as we go through, we think that's probably less remote, that there will be some legislation. One is you can assume that it's going to be the tax reform will be passed in November or December, likely late December by the time it runs through channels, and be effective January 1st. The other thing that could happen is the legislation could slip into the spring. The problem is the closer it gets to the election, the midterm elections next November, the less likely any politician is to stand up and take a stand on anything, as we all know. So you have that as well. And so you have these various tax bills, and you have this standing tax bill that we have right now that you have to incorporate into your planning as you go through. The beautiful thing about teaching this or speaking about this tax reform bill is nobody knows exactly where it's going. So at the end of the day, how dumb can Dawn and I look, When you come back in January, you say, I told you, we don't know. So we're going to go through a little bit of the history of where we're at, and then we're going to get into 2 broad pieces of legislative documents that have come out recently. The first one being a framework which kind of follows the overall plan. And make no doubts about it, it's a Republican plan. They control the House and the Senate, and they control the White House. So it's not a situation where they're interested in what the Democrats have to say. So that's not to say that there isn't some input, and I'll shed a little light on that because the Democrats would have you think that they've had nothing to do with this legislation, but in fact they have. The core of this legislation goes back to the Tax Reform Act of 2014. I don't know how many of you remember that tax bill. It was never introduced. But in that document, which was released by Dave Camp, a Republican from Michigan, when he was chairman of the House Ways and Means Committee, they laid out a very substantive statutory piece of legislation in February of 2014 that would serve as the basis for real tax reform if they were presented the opportunity, they being the Republican contingent that was the majority in the House at that time, moving forward. So that served as a framework then for all of the Republican candidates in last year's election. So that was in the fall of 16, it was only removed 2 years. And we're not going to cover the Tax Reform Act of 2014, really wouldn't be that relevant, excepting that it's pretty much you can go through it provision by provision and stack it up against the current House bill. So the question is, how can you write a 400-page document, the recent House bill that was introduced, in a couple of days? They had most of it done. And they had it done years ago. So all they really have been doing is tweaking that original piece of legislation, and that's where we're at. Now, we haven't seen major tax legislation since tax reform legislation of this magnitude since the 1986 Tax Reform Act when Mr. Reagan was president. And that bill was massive and made wholesale changes to the Internal Revenue Code, so much so that they renamed the Internal Revenue Code of 1986. And that's the one we're still using today. Prior to 86, there had only been those types of major adjustments or reforms of the Internal Revenue Code in 1937 and 1954. So you can see over time, these major pieces of legislation come through in a very limited capacity, only periodically. When we talk about this today, and Dawn and I are going to go through each of the provisions as we understand them where they are now. And please appreciate it, I wasn't kidding. I mean, this is a very fluid process, and what we see are changes that are occurring daily through the congressional markup on the House Ways and Means Committee, as well as the chairman of the House Ways Committee. The basis for this particular bill and the basis for this legislation comes out of the budget process. And the House approved a budget a couple of months ago, or a couple of weeks ago, like 4 or 5 weeks ago, and voted on it and went through. Just a week and a half ago, the Senate passed their budget. And it basically got through the Senate in a way that allows them to eliminate the ability of the Democrats to cause any problems in passage later. But there's only two ways to do that. And the most major of those two ways, beyond the agreement of the two houses, the Senate and the House, is to make sure that the deficit that's driven by this, and to be sure, as John said, it's cut, cut, cut. You're going to see additional deficit growth by virtue of this tax bill in the near term. It can't exceed $1.5 trillion over 10 years. Right now, the House bill as it was originally released last week, I think last Thursday on the 2nd, about 11 in the morning, that bill had about $75 billion overspend. You know, a billion here, a billion there, pretty soon it starts to add up to real money. So what happened is the chairman of the House Ways and Means Committee, Kevin Brady from Texas, he made some changes over the weekend and released them on Monday, which were meant to basically move that deficit increase down to the 1.5 trillion that you're talking about. It's the cap. As long as they do that, the Democrats won't be able to filibuster, and what will happen is the Senate itself will be able to pass the legislation that comes through at the end with a 50% vote instead of a supermajority vote. So it's a political move to get it through there and make it pass. And that's where the legislation is at this point on the legislation. So it came through last week. Understand the House bill. That was built on a framework that was released, a 9-page document that was released on September 27th. And it pretty much follows that document. Dawn and I will go over that framework document because it's being used by the Senate as well. And they built out of that framework the House bill, and what's it called? The Tax Cuts and Jobs Act? Yeah. The Tax Cuts and Jobs Act of 2017 is the name of the legislation, or the House bill anyway. And that's where we're at this time. As I said, last Tuesday or last Thursday, it was released. The chairman marked it up over the weekend. The full House Ways and Means Committee started doing their markups on Monday sometime. There's been a couple of additional releases of changes that the House Ways and Means Committee has made so far. The Democrats have input. Other floor members that aren't on the Ways and Means Committee have input. And so there's a process that's in place with the hope that they can vote on the House bill next week, okay, and get it to the president before Thanksgiving. That's a push from the White House. That's what the House Ways and Means wants to do. Now, the Senate bill hasn't been introduced yet, to our knowledge. We were told that it was going to come out yesterday, today, and tomorrow, and now they're talking about, because of the defeats that the Republicans took in the governor's races in New Jersey and Virginia on Tuesday, that's probably going to be next week before the bill comes out. We really have no way of doing this beyond the ways that you have. We just monitor our reporting services and the news wires, and we watch. And right before I came in here, I checked. I saw nothing that the Senate bill came out this morning, to our knowledge. The process will be one: the House will vote on their bill, the Senate will vote on their bill after they have a chance to mark it up. The Senate Finance Committee will send representatives. The House will send representatives from the Ways and Means Committee. The two will negotiate a deal where there's one single bill between the two, a reconciliation package, if you will. It'll go back to both houses. They'll vote on it, and it'll go to the president. So he's sure to sign it, because the observation or the issue is the Republicans haven't done squat since they got into office. And they fear not getting any major legislation through in the first year of the office. They failed on Obamacare, as we all know, and now they have this desire to get this tax bill pushed through, and their goal is going to be to push it through as quickly as possible. Luckily, again, they had this 2014 Tax Act, which helped them give them a base for the legislation that's being developed right now.
Just a couple comments. The bill comes out of the House, and we're not going to have any. The president's not going to have any problems getting the House bill accepted by the House of Representatives, because he's got enough votes there where it's not going to matter. The problem is on the Senate side. Now, obviously, as we know, the Republicans control the Senate, but it's only by a couple bodies. As you know, there are 100 senators. The Republicans control the Senate, but if he has 2 or 3 Republicans that vote against it, he's going to lose it. So what we're going to find once it gets to the Senate side, and one thing to keep in mind is this package, the framework as we talk about it, is as big as it's going to get as far as tax cuts. There's not going to be additional tax cuts after this, most likely. This is as big as it gets. From here, it's just going to be chopped down by the House, and then chopped down again probably by the Senate. So as it goes to the Senate, and as the Senate comes up with their own bill, it's going to be a little bit less than what we have now. But the president can only afford to lose 1 or 2 Republicans that vote against it before he can't get it passed, which is what happened with the health care issue. He couldn't get it past some of the Republicans who would not allow it to get through because he didn't have enough votes.
Yeah, and you'll see as we go through the morning or through the discussion, and Don will be talking about state and local tax deductions, for example, there are issues of great concern to representatives on both sides of both chambers with respect to certain provisions being knocked out of the code that affect their constituencies directly. And that's their job, right? Their job is to represent the people in their districts and try to protect their interests going forward. Let's talk about the goal of tax reform, because this isn't really part of the bill, but it's part of the language that we often see in talking about this. You know, anytime you do tax reform, it should be with the motivation and goal, of course, of minimizing the damage that's caused by taxation. We clearly need taxation to run the government. We all get that. I don't think anyone disputes that. But the idea is that when you put money into the federal government's hands or the state government's hands, you know, we're essentially taking out the business owners' hands and the taxpayers' hands, where they may be better apt to deploy that in a way that creates jobs, creates economic gains, and so forth. So that's the big issue that we're looking for. So let's create faster economic growth and opportunities for all. And again, threading through this 14 Tax Act, this framework that we're going to talk about, and then ultimately the House bill, the Tax Cuts and Jobs Act, you're going to see these themes running through these over and over again. What I would tell you is John mentioned again that the bill's comprised of cuts, and it's true. The tax rates are going to be much lower percentage-wise than they are now, with fairly substantial percentage cost cuts between a 39.6 bracket, for example, and a 35% bracket. What I would tell you, which is disturbing to me, but is sure to happen again before I die, is if you looked at the '86 Tax Act, we gave up a lot of deductions. The taxpayer community. We created additional taxable income, but we gave up a ton of deductions. But that was okay on both fronts. The tax income creation was to create revenue and try to balance the act. That was part of the negotiated process. The rates were the trade-off there. At the end of the '86 Tax Act, there were 2 rates, 15% and 28%. That's the way Mr. Reagan wanted it. And it was perfect. It lasted like 18 months. And then they moved the rate up. Then Mr. Bush came in, they moved the rate up again. Then Mr. Clinton came in and moved the rate way up, percentage-wise. And yada, yada, you're right back where you were before. That you're going to see 40% tax rates probably in a decade with all your deductions will have been gone. So there'll be no planning there. So it works in the year that major tax reform happens. But what we see and what we continue to see and what we'll discuss throughout this presentation is this concept and idea that there's not only these marginal rates that Don's going to talk about, but there's hidden increases in the marginal rates by limitations on other deductions. And we'll get through on that as well. So we're going to talk about this morning, focusing on addressing the marginal rates and the focus on the highest rates. In this country, it's hard to imagine a time when the highest earners didn't pay the highest percentage. But it's only been that way since the 40s and 50s. I mean, and into the 60s when they were financing the Vietnam War. I mean, the reality is, for a long time, it was kind of a proportionate thing, not exactly a flat tax, but there wasn't this overriding idea that the wealthy should pay a greater percentage. That has now become so ingrained in the American psyche of tax law and tax compliance that very few people would look at that as being something other than the just due for being successful. So it's a difference. Tax-based mobility is about basically making sure that you protect the tax base that's there and that it achieves tax-based neutrality, meaning nobody's paying significantly more taxes than they were before, and wherever you can manipulate the system to work the numbers, that certain groups will pay less. And certainly they want to try to give a tax cut in this legislation to all brackets, not just the lowest or the highest, but a great deal of benefit to the middle class is at least what they're arguing.
One of the things that I think is very important or very interesting about this Tax Act, and I've beat the heck out of this thing over the last week, as has Bob, but in my opinion, reading this Tax Act, it's getting back to fairness in a lot of cases. And I'll show you some examples later that talks about fairness. Bob and I making the same amount of money, and at the end of the day, we have the same job. We make exactly the same amount of money, $110,000 a year, but I pay $10,000 more in tax than he does because of the way the tax code is set up. My interpretation of this Tax Act is getting back to something that's more fair, so somebody living in California is paying the same amount of tax as somebody living in Pennsylvania if they're making exactly the same amount of money.
Yeah. So we're going to talk a little bit, as I said, about the two primary documents driving this process so you kind of know where things are at. What we all get are bits and pieces out of the newspapers and the media, and they're never complete. And this is meant to give you kind of an overview of the corporate provisions, the estate provisions, and the individual provisions that will affect all of us. This document was released on September 27th. I think it was released in response to the demand by the media and the constituencies to get something out to the public, because they were supposed to release this bill in June, July, August. Nothing was happening. So on September 27th, they released this 9-page document called a Unified Framework for Fixing Our Broken Tax Code. We're going to refer to it here as a framework. The one thing I want to tell and advise everybody in the group is within your materials today, because we crafted them before the House bill was released, we put together some examples with some of the managers in our tax group. The examples now are basically worthless. So don't depend on them, because things changed enough between the framework and the House bill that some of the broad assumptions we were making to provide you guys with some illustrations really aren't as relevant now. So we are going to update those examples, and we'll have them on our website in a few days. But understand, we're not going to go through them today just because there's some obvious glaring glitches that doesn't comply with where the House bill is at the current moment and are not likely to be reinstated. So in certain cases, there's clarification. In other cases, there were actually changes. So that's where we're at as well. This particular document sets out 4 overriding principles to consider. Making the tax code simpler, fair, and easy to understand. No card?
450 pages so far.
Yeah, it's not the shortest revision.
Well, I think at the end of the day, and what we're going to find is from an individual's point of view, it is simpler because there are less options, there are less deductions, not as many decisions to make as far as deductions. So from an individual side, it seems to me that it's quite a bit easier than it was before for probably 90% of U.S. taxpayers.
Yeah, I mean, I think if you're paying taxes, none of these 4 things should be mind-blowing to you or unreasonable. I mean, making the code simpler, fairer, and easier to understand. You see Representative Ryan, the Speaker of the House, holding up the postcard-sized tax return. 3 inches by 4 inches, and that's it. That's all you have to file anymore. It's not going to be that simple, though, without giving away a lot of the traditional benefits that were there. I don't know how many people saw Saturday Night Live last week, but on Weekend Update, one of the people that were reading the news talked about that postcard-sized tax return and the legislation itself.
The postcard's actually a lot bigger than it looked on TV. This is the actual size. The biggest problem with the postcard, being that there's already a stamp on it, the biggest problem with the postcard is going to cost you $47 to mail it.
Yeah. The guy on the Weekend Update said, we really don't want simpler because it's so much harder to cheat if it's simple. So if you make it long and complicated, there's a lot more room for all of us to cheat on our taxes. It'll get us there. The next overriding principle is that the American workers deserve a pay raise. And here we're talking about the middle class, of course. It's allowing them to keep more money in their paychecks, less withholdings, less overall tax liabilities. So those are two big themes which I think were put in there as part of unilateral discussions with both the Democrats and the Republicans in developing that 2014 Act. They want to make America a magnet for the world. Where we have a big problem in the United States is on this inappropriate and outdated and antiquated international tax system that we use in this country, which is used almost nowhere else in the industrialized world. And it's very penal in a lot of circumstances, and what it's causing, as we all know, is a lot of companies to move headquarters, move operations out of the base of the United States, out of our tax base, into somebody else's tax base, which is more advantageous. That's a significant problem, and certainly Trump's been, ranting about that since he started running his campaign, and it's a place where the Republicans have been for a long time. Let's try to clean that up. Let's make it more affable, if you will, to do business in the United States. And then the people that have been doing business offshore are sitting on trillions and trillions of dollars. So they say. I don't know who's doing the math or where they get the detail. But the idea is, let's take some of that foreign earnings that's sitting over there, repatriate it back into the States, and get some economic flow going from the inbound flow of those funds from overseas, and repatriate them rather than having all that money sitting in foreign domiciles. So again, those themes kind of capture those three overriding principles of tax reform at any time, and they're the overriding themes in the framework itself. So the principles are consistent with the goals. The framework also lists these goals that are there.
Yeah, and the middle class, I mean, what's the definition of middle class? Does anybody even know what that is? I don't even know if I know what that is. So, but as I work through the tax changes that I've seen, it seems to me that most people who are in the middle class are going to see a tax cut here. Not all people who are in the middle class are going to see a tax cut, however, because there are certain things that a lot of people are doing that is quite legal under the law, but with some of the changes, it's not going to be permitted anymore. Certain deductions are going to disappear, and when we talk about that later, I think it'll make a lot of sense to you that it really makes sense to get rid of some of these deductions, because not everybody should get a deduction for certain things, and we're going to talk about that later.
Yeah, we've already talked about the simplicity issue, the better understanding issue, and postcard filings. Tax relief for businesses, and one of the provisions that we'll talk about here is a modification to the tax rate scheme that's currently under the law that applies to pass-through business entities. After the 1986 Tax Act, we had a flip in tax rates. For many, many years, almost the entire time since the code was put into place in 1913, corporate tax rates were less than individual tax rates. In fact, when I got out of college, the individual tax rates were 70%. And when I was in the Army, the tax rates were 90% on some income in the US. So people put together corporations, and they held money inside the corporations, which drove another issue for the federal government. They wanted to force that money out, so they adopted provisions like the accumulated earnings tax, which said you can't keep too much money in there. You have to dividend it out and pay tax twice. So you have those provisions. But in the 1986 Tax Act, for the first time, the individual rates were far less than the corporate rates. The corporate rate in that bill was 35. The highest individual rate, as I said, was 28. So people started reorganizing all those corporations into companies that could qualify for S corporation status and for partnership status. And so where they could do that, they did it. Everybody made the election. And since the 90s, when limited liability companies started to grow in popularity, almost all businesses are either passed through limited liability companies taxed as partnerships themselves, or S corporations. Very few organizations, unless you have special purpose motivations, are incorporated as a regular corporation, subject to those kind of rules. So the small businesses that they're talking about there is the relief that's for pass-through entity owners, okay? And we'll talk about the mechanic of how that works based on the tax rate changes that are being advocated as Dawn and I get into it. Again, ending the incentives to ship the jobs, the capital, and the tax revenue overseas, and then broadening the tax base of the United States tax system so that there's greatest fairness for everybody by going through there. So I'm going to let Dawn start here. We're going to go through what the framework said. And the reason to go through the framework, even though it predated the House bill, is to give you some idea of where the Senate's coming from as well, because I'm sure the Senate is working from this House bill and the framework primarily because it was promoted on its release by both the Senate Finance Committee and the House Ways and Means Committee.
Yeah, and I just have a couple slides on the individual framework. Again, building the framework before we get to the actual bill that was passed by the House. The original framework was talking about reducing 7 brackets as they exist currently down to 3 brackets to make it simpler. All right. Does anybody, after they figure out what their taxable income, does anybody have any problem figuring out how much tax they owe? I mean, you can get a 3rd grader to say, okay, if you have $100,000 of taxable income, look in the book and tell me how much tax you owe. That's pretty simple. So the fact that they say that reducing the brackets makes it easier really doesn't make sense because it's so easy to do it. But the framework says let's reduce the 7 brackets down to 3. And those are only the income tax brackets. Does anybody know how many income tax rates are really out there for individuals? Anybody have a guess? And everybody's doing the counting in their head, especially the CPAs out there who do tax work. It's about 15. It's somewhere between I'll say 13 and 18. Could you imagine that? 15 different tax brackets for an individual, depending upon what type of income he has, whether it's capital gain, ordinary income, self-employment income, Medicare tax, all those other things. So moving it down to only 3 brackets still doesn't mean there's only 3 brackets. I'm sorry, doesn't mean there's only 3 rates. There's only 3 rates for income tax purposes, but for other taxes, there are still rates out there. But for 90% of Americans, it's simpler because there are three different brackets.
Our modus operandi is generally, if you can't find when your income's $120,000 and it's between $100 and $150, if you can't figure that out, you shouldn't have a driver's license.
And at the time, they left it open that there might be another larger bracket coming, a higher bracket, because as you can see, the highest bracket at this point was 35%. And there are a lot of things they left open with the framework. It does note specifically that the plan was the typical families who are in the 10% tax bracket, which is the lowest tax bracket, will see even greater savings going forward. Even though lowest bracket is now 12%, people in the 10% bracket are actually going to save money because of the higher standard deduction. Second point is the standard deduction. And the plan was to increase the standard deduction, pretty much double the standard deduction. What that means is for those people who don't itemize, their standard deduction just doubled. So if you're married filing joint, you had $12,000 standard deduction under prior law. Under this proposal, it moves up to $24,000. That's a big tax difference. You know, for somebody who's making $25,000 a year, that's a huge tax savings for them. One of the trade-offs, though, is that you lose your exemptions. So if you have 2 kids, you lose the exemption, which is about an $8,000 deduction. If you have 4 kids, you lose even a bigger exemption. But again, there are other things in the package that make up for that at the end of the day.
That's when we started looking at this framework a couple of weeks ago when it first came out. That was the interesting element of it. They talk a great deal about expanding the exemption and moving the exemption up from 12.7 to 24 for a couple. That's significant. But if that couple has no children and you lose $8,000 worth of personal exemptions for yourself and your spouse, as Dawn said, now the gap shrinks very small. If you have one dependent, just one child, you know, a young couple with a baby, and together they make $150,000, at that juncture, they're in worse shape under this provision without these other family credits that Dawn's going to talk about. So it wasn't clear in the framework exactly what their intent was, but you'll see when we get to the House bill, it's definitely clear now.
Yeah, and the next thing is talking about the elimination of most itemized deductions. Basically saying, hey, we're not going to allow you to deduct your state and local income taxes anymore. So everybody who itemizes is sitting in the room is going to say, well, I don't like that. I like that state and local income tax deduction. I'm going to talk to you later in the program. I'm going to convince you why you're going to like that, the fact that they got rid of that. They also talked about getting rid of the deduction for real estate taxes, which is subsequently changed. Okay, so the Schedule A is going to change dramatically under this proposal. They also limited the mortgage interest deduction. That was also in the framework, and they were more specific in the House bill. A couple other changes, including changes to the child tax credit. Right now, the child tax credit is about $1,000, and they talked about tweaking that, which they did in the bill. We'll get to that. And the repeal of alternative minimum tax. How about that? Finally, we're actually talking about alternative minimum tax, and it will not be an issue or a discussion point in any of my other seminars going forward in the future.
Don has talked about AMT 7,416 times, and it's the only thing he knows really well, and they repealed it. He's out of luck.
And every discussion about tax will ultimately end up in AMT, because that's the only thing I know about. And then the repeal of the death tax, the estate tax. That's a pretty big political issue there that we'll address that a little bit later on also. Some of the things that they want to retain, including higher education incentives, paying for your kids to go to college. I can't even tell you, to be honest with you, all of the laws relating to college education. Can you?
No, but there's
about 47 different
there's
provisions.
A ton of provisions, and each one is mechanical in nature, and it is a lot of ridiculous overlap between one thing and another. So parents with kids in college, they struggle to get any value out of it anyway.
Yeah, so the plan in the framework is, hey, let's make this a little bit simpler for everybody. Again, we're trying to get simplification for individual taxpayers. And then the last thing, talking about the elimination of many existing provisions that exist. For some reason, we don't know why we get deductions for some of the things, but you do. And a lot of those deductions are going to disappear.
Yeah, there was no detail on that in the framework itself, but the House bill, as Dawn and I will show you in a few minutes, includes an incredible amount of provisions that have been repealed and will go out of existence as well. The tax changes for business, the goal there was obviously to facilitate competitiveness and growth for job creators. That's been a mandate and a mantra for the Republican Party for a long time. I don't think the mantra itself is objectionable to the Democratic side of the aisle, but the way you go about it is a little bit different. So what they're advancing is a different and new tax structure for small businesses. We knew that was going to come in with a lower tax rate. That had been bantered about by tax writing committees and people within Congress for a couple of years. A reduction in the U.S. corporate tax rate, and we've all heard a lot about that because you have your largest corporations now are going to have a substantially lower tax rate on their taxable income. And then basically, again, those international provisions. Rework the international parts of the Internal Revenue Code to put the U.S. on a more competitive and comparable basis with the rest of the industrialized world as well. The small business tax rates, what they're doing is limiting the maximum tax rate that's applied to business income of small and family-owned businesses. I don't think they put the rate in the framework, and we'll talk about what that rate turned out to be ultimately. Everyone had suspected from the beginning that it would be something more than the corporate rate, but substantially lower than the highest individual rate. And then the regular corporate tax rates, that's gotten all the media attention and all the press. The average tax rate for the industrialized countries in the world that we compete against is 22.5%. Ours is 35%. Now, granted, we don't see a lot of corporations that pay tax at a flat 35%, but there are those that do, and a substantial number of them. And so ultimately, that's a huge boost in cash flow for those companies if they're not going to be paying out that tax. And we'll talk a little bit about timing of that and exactly how that's going to work mechanically when that comes into the law as well. And then also the framework provides a provision, and these are very generic elements. Remember, this was a press release more than a piece of legislation that, the law that's ultimately issued by the House Ways and Means Committee later on, post-September 27th, can also consider methods to reduce the effect of the double taxation of corporate earnings. And everybody should be familiar with that concept, but we're simply saying a corporation has $1 million of pre-tax corporate earnings. The first tax they pay is $350,000, 35% of that million. That leaves them $650,000. You distribute that out as a dividend, and depending on the age of the earnings, if it's current earnings, it'll be subject to a tax at 20% when it goes out as a dividend to the shareholders. So ultimately, you have these two layers of tax. That's a very problematic tax structure in a competitive environment, and this law is supposed to provide an avenue for that to be cleaned up and taken care of a little bit. On the expensing of capital assets, we're going to allow businesses to write off the cost of investments in depreciable assets. Now, again, there's some limitations there, but for the most part, everything's going to be expensable. As long as it's qualifying property subject to this provision, which is generally going to be 5- and 7-year property, it's going to be able to be expensed now. We'll talk about that a little bit more, especially this idea of decoupling when we get decoupling with the states when we get to the House bill itself. The interest deduction limitation here is something new. There's a concept in the framework that flowed through into the tax bill, which is an idea that at the corporate level, they're going to disallow certain amounts of interest expense under Code Section 163 as a current tax deduction. And so those amounts are not going to be deductible at all. You'll see the mechanics of that as well when we get to the House bill. I don't want to move ahead of where we're at, but that's a big change. And we don't know why that change is there yet. We've not seen committee reports. We don't see a lot of flush language in the House bill at this point, but we surmise anyway, Don and I, for what little we know what's going on in the world, that if they're going to allow you to expense the entire asset, that's almost like a double benefit to allow you to deduct the financing costs as well for those assets. And so there's, on a broader scale, it's not tied specifically to that provision in the House bill, but on a broader scale, I think that's what they're trying to do. As a revenue offset, we'll let you expense them, but maybe all the financing costs aren't going to be deductible as well. Other deductions and credits aren't going to be necessary. And the reason they're not going to be necessary is because the tax rate's now going to be low. So they talk about everything in the construct of the framework in the context of the corporate tax rate being 20%. And with such a low tax rate, you don't need some of these other deductions. One of those is the domestic production activities income deduction under Code Section 199 that was added, I think, in 2006. Unbelievable. We only spent about 2 years of our lives, Don and I, getting a grip on that code section, and now it's going to disappear. But the idea was that deduction, that 199 domestic production activities deduction, was intended to help U.S. companies be more competitive with their foreign counterparts. Not going to be necessary now because the tax rate's 20%, and they're going to modify some of the international rules to accommodate. Other things that they think are important to job creation specifically, one is R&D, and R&D is going to remain, as will the low-income housing provisions within the Internal Revenue Code, with the thought that those are both useful and serve a predictable outcome there. Then again, they leave these catch-alls in there that others can be retained or left depending on the budget limitations. Well, believe me, they spend all the money. Again, they have a $1.5 trillion cap. When they get there, they're done cutting. And then specific industry provisions, they're going to go after certain specific industries. There's a little bit of oil and gas industry information in the House bill that you'll see. And there's also a lot of energy, non-oil and gas, non-natural resources energy industry provisions as well in those bills. We're not going to spend a lot of time on those today because they're very specific, but that's where it's at as well. And then on the international front, they're going to talk about increasing America's global competitiveness with this American model. What they're going to do is eliminate the corporate moves outside the U.S. borders and put American businesses on a level playing field and get rid of some of the incentives for shipping jobs overseas. That's the overall goal in this particular transaction as well. The first they do by moving to a territorial taxation of global American companies. Basically what it does is it's going to allow, instead of us getting 100% of the tax on the U.S. nexus type income here, it's going to allow us to get a smaller bite of the entire worldwide income. And that's not a foreign concept to companies on the international stage. They see those kind of reaches constantly. And again, most industrialized countries already have that kind of territorial reach as well. They're going to exempt, or their intent was to exempt in the House bill, and they really want to do this in conjunction with the final bill that goes to the president that both chambers vote on, is to get some of this money that's overseas back without a huge penalty. So that's an issue as well. So we're going to be replacing our outdated world tax system with a 100% exemption for dividends from foreign subsidiaries. But that's only going to be in a situation where the U.S. company owns at least 10% of that foreign subsidiary over there as well. We already talked about the territorial system, taxing foreign profits of U.S. multinationals at reduced rates on a global basis so that we can be more competitive. We've talked about that as well. We'll save the thoughts of where this is going to the end and go into that. But what I'd like to do now is turn over to Dawn. We're going to start talking a little bit about the Tax Act itself. And again, the Tax Act was released last Thursday morning at about 11 a.m. to much hullabaloo by the House Ways and Means Committee. It is currently, as I said, in committee markup. It is a mostly forward-looking document. We had hoped when Mr. Trump got elected last year in November that we would see some legislation earlier than this and that there would be a effective date sometime in 2017, if not going all the way back to the beginning of the year. Obviously, when you get into a circumstance where the legislation starts slipping on the calendar, the further you get away from January 1st, the less likely it is to go back. So now we're going to be signing the bill. You're going to be eating your turkey dinner on Christmas, and he's going to be breaking into the news while you're trying to watch football and tell you that, hey, we're going to pass this tax law now at the last week of the year, as usual. So that's the way it's looking more and more to us. The bill itself, most of the effective dates are forward-looking, as I said, into 18.
Yeah, I think as far as I can recall, Bob, the only provision that is effective in 2017 is the expensing of assets, correct?
Yeah.
If you buy assets between now and the end of the year, you can expense 100% of them. I think there might be one other provision. But it's not material.
I think there's a provision on the corporate tax rate, but I don't know how they can do that. So I think that will slide away.
Yeah, so as we sit right now, if it passes as is, and it looks like the only thing that slips into 2017 is the current expensing, which is huge for corporations, right? Because think about it. We know for sure that tax rates are not going to be higher next year, right? But most likely they're going to be lower. If this bill finally gets signed into law, the tax rates are going to be lower next year. So what do we want to do? We want to accelerate all of our deductions into 2017. We want to defer income into 2018 because we know the tax rates are going to be beneficial. And if we can go out and buy a $100,000 piece of equipment knowing that we can expense all of that in 2017, we want to do that before year end. So what we're talking about now is the Tax Cuts and the Jobs Act, the actual bill put forth by the House. And again, we're building off the framework. They took the framework, made some adjustments, and this is where the House bill landed. They did add the other tax bracket, 39.6. Remember, we're talking about 3 brackets initially. They said it might add a 4th, which they did. So the bill says 4 tax brackets: 12%, 25%, 35%, and 39.6%. The other thing we now have is we have the income ranges where at which point you pay taxes, because as we know, it's a graduated tax system. First, in this case, as married filing joints, first $90,000 would be taxed at 12%. So what you have to think about is, okay, where were the brackets before? Where are they now? And is it good, bad, or indifferent? What I did is I looked at each one of these brackets. Okay, I looked at, okay, if you're making $90,000 as a couple in 2017 as compared to 2018, are you going to be better off next year versus this year? And in every situation, I looked at these, I think the first 3 rates you're going to be better off. The first 3 brackets you're going to be better off. If you're just looking at the tax rates and the brackets, you're going to be better off. The highest bracket, you're not going to be better off. You're going to be way better off. Because right now, if you make $470,000, any dollar you make over that $470,000 now gets taxed at 39.6%. Under the new law, you don't hit that 39.6% until you hit $1 million. So we have $500,000 of taxable income that gets taxed at a lower rate as compared to where the bracket is now. And that's where the Democrats are screaming, what would they be screaming? Foul? They'd be screaming foul, that this doesn't make sense, is giving huge tax breaks to the wealthy. And if you only look at the rates, then that's a good argument. But if you look at things other than the rates, then that's not a good argument. We'll talk about itemized deductions and how those come into play in a little bit. Yeah,
that's a great point that Dawn makes. I mean, the essence of it is looking at taxable income and net tax liabilities versus pre-law, post-new law. And the reality is, yeah, the rates look better. They look more attractive, especially for higher income people. but there's a lot of phase outs and a lot of losses for those individuals that they previously had that they no longer will have. So they'll have same facts and circumstances. I assume at this point, and we have to work through examples, that they will have appreciably higher taxable income at the end of the day.
That's exactly right. So if you just say, okay, $500,000, you're reducing your tax rate by 5%. If you're at that level, you're going to save $25,000 of tax, right? Well, if you have $1 million of taxable income, you're paying state tax now. I mean, that's a big tax hit. That's a $30,000 tax hit, right? Because you're paying state taxes. Well, you're no longer going to get that state tax deduction. So at the end of the day, you have to take everything into account just before you can just automatically say, oh, this is benefiting the rich. At the end of the day, you have to take everything into account, and that's one of the things we're going to talk about as we move forward. The Act confirms the increase in the standard deduction. Okay, so prior year's standard deduction, $12,000, married filing joint. Now the standard deduction is automatically $24,000, so it's close to double. And my numbers are a little bit off because these numbers actually do not include the inflation adjustment. So the 2018 numbers will actually be a little bit higher than this. But if you don't itemize, and in prior years you had a $12,000 standard deduction, and then in 2018 your standard deduction goes from 12 to 24, that's a huge windfall for you, right? All of a sudden your itemized deductions doubled, which is going to save you a couple $1,000s of tax. So the winners with respect to the change in the standard deduction are those people who do not itemize. And as you can see on the screen, only 1/3 of Americans itemize. Okay, so the other 2/3 of the people are going to benefit because they don't itemize. So they just increased their standard deduction from $12,000 to $24,000. That's a pretty nice windfall. So we went from 33% of Americans itemizing, and now we're going to be less than 10%. Okay? So I did the math, and there are about 44 million Americans that itemized under old law. Under the new law, only about 15 million Americans will itemize. So who gets hurt by that? How about H&R Block, right? All of a sudden, H&R Block, they did all those tax returns. I can't imagine what's going on in their offices right now, because a lot of their business, and they still may be doing tax returns, but if you can do a tax return on a postcard, why are you hiring H&R Block or Hewlett, what's it, Jackson?
Hewlett Jackson.
Yeah, Jackson Hewlett. Why, you don't need them anymore because you're doing it on a postcard. So now we're back to that postcard discussion. Is it really going to be that much simpler? Well, if all you have is a W-2 and you're not itemizing anymore in a standard deduction, boy, it gets pretty easy, right? Tax return gets a lot easier than it was before because you don't have to keep all those records, because it's pretty hard to get to more than $24,000 before you itemize. I mean, you have to be living in a pretty big house to have mortgage interest that high. So the number of Americans that will be itemized going forward is significantly less than it was before, which makes the individual tax law much simpler than it was before. Other losers. You may think of any other losers in this as a result of this standard deduction. How about the charities that take property or clothing? How about Goodwill? How about organizations like that? I think they might get hammered because of this. Because how many of us have been to Goodwill on December 31st? Right? We've all been there, right? Everybody takes their clothes on December 31st, and no matter what you paid for that box of clothes, it's a $1,200 tax deduction. We all know. Don't lie. We're all committing tax fraud, and we all know it. And that's already built into the budget, so the government knows you're cheating. But doesn't that change now? I mean, do you still make that trip? Well, you should, but are a lot of Americans just not going to make that trip anymore because they're not getting a tax deduction for it? So you know, I think organizations like Goodwill and the paralyzed vets, they might be in trouble here as far as property donations because of this.
Yeah, I think the issue is that people's charitable inclination should not change, I don't suspect, but the directness of the tax benefit to the charitable contribution, you're going to give $5,000 to your alma mater at Christmas time, and you're going to write a check out. I mean, you know that that's only costing you $3,000, $3,500 if you itemize currently. They're giving you the same benefit if your total itemized deductions plus your standard don't exceed the $24,000, but it's not as direct. And I think without that direct connection, I agree with Dawn. I think you will start to see charitable giving down somewhat, and a little bit more of a struggle for those types of organizations to raise monies.
A couple other changes. It completely eliminates the dependency and personal exemption allowances, which were $4,000. So who does that hurt? You know, doesn't that hurt the guy that has 4 kids or the family that has 4 kids? Because before you got a deduction of $4,000 times your 4 kids plus husband and wife. I mean, that's a big tax. You're already up around $24,000. So boy, it feels like it's really going to hurt the people who have a lot of kids. And when I first looked at this, I'm like, God, I don't think I like this. But when you dig into the numbers, and we'll talk about the child tax credit later, kind of works out to it's not that big of a difference. And because of the $24,000 standard deduction, for a lot of people, that was a huge increase as compared to prior years. It's okay to lose the exemption, unless you have like 12 kids. Then it's a big problem. But there's an offset to losing that. The other thing that was restored in the bill was the property tax deduction. Initially in the framework, they were not allowing any tax deduction for property taxes. So who does that hurt? Hurts Pennsylvanians, right? Because our property taxes are a little bit out of control. So if we lose 100% of the property tax deduction, that's a pretty big hit. But they put it back. They put it in the bill, and they allowed up to $10,000 of property tax deduction. So for most people, that's going to be okay, because our property taxes are maybe in that ballpark, maybe a little bit less, depending upon the size of the house. This deduction, though, is only allowed going forward for your primary residence. So who does that hurt? How about that hurts the people who have that vacation home down in Hilton Head, and they're paying $10,000 of property taxes on the vacation home down in Hilton Head. Now all of a sudden they don't get that tax deduction. The other people that hurt are the people in New York City, people in San Francisco, the people in California whose homes are like little 2-bedroom homes that cost $1 million, and their property taxes are outrageous. That hurts those people because now they can't itemize anymore, because they don't get they can only take a tax deduction up to $10,000. So that definitely hurts those people. And then the last bullet point there, the provision, there's no provision. The framework says we're not going to give you a tax deduction for your state and local income taxes. Okay, so who's that going to hurt the most? Is that going to hurt Pennsylvanians? Pennsylvania, our tax rate's actually pretty low. Our state income tax rate is actually pretty low at 3%. We have 1% local tax unless you live like in St. Clair or downtown Pittsburgh, where it's a couple percent. But at 4 or 5%, it's really not that bad as far as state income tax. But how about if you live in New York? How about if you live in California? California, I think the highest personal income tax rate's like 12%. And you see a lot right now, especially the folks from New York, the politicians from New York just screaming and crying, and like Bob said earlier, they're trying to protect their people, saying, you can't take that tax deduction away from us because you're increasing the taxes on New Yorkers. But is that really the right answer? You know, the politicians coming out and saying, you can't take that away, you're increasing taxes on our people, our New York residents. So I kind of attribute that. You know, you go to a doctor and say, Doc, it hurts like this when I do this with my arm. And what's a good doctor going to say? Stop doing that. I think the answer to the New York politician is it's not a federal issue. The fact that we're not allowing you to deduct these taxes anymore, that's not a federal issue. That's a state problem. Your taxes are too high. So don't try to point the finger at the feds and say, nah, you're taking that deduction away from us. How about you lower the taxes to a more reasonable level in New York and in California? That seems like a better answer, and it's more fair. Because as a Pennsylvanian, if I pay $10,000 of property tax, I get a deduction for $10,000. Just because Bob lives in New York, why should his federal income tax be lower because he pays $20,000 of tax? Because he has a home in New York and he has a home in Hilton Head. Doesn't it make sense that it's not a federal problem, it's more a state problem? So that's the state and local income tax issue is a huge issue right now. I mean, I could pull up probably 15 different articles that I've read over the last 2 weeks addressing this specific issue. And I think the language in the provision, well, at least it was in the summary of the provision that I read. I'm going to read this word for word because I think it's actually very interesting. It says, this provision would eliminate a tax benefit that would effectively subsidize
higher state and local taxes, and increases spending at the state and local level. Kind of sounds like the feds are saying, hey, states, get your game fixed here because we're subsidizing you. Don Johnston, paying tax in Pennsylvania, is subsidizing somebody's vacation home who lives in New York City. And as I step off my soapbox, let's move down a little bit.
You know, well, go ahead, I want to talk about after you go through the mortgage interest. Go ahead.
The mortgage interest, will continue to be able to take a tax deduction for mortgage interest, but it's going to be limited. For homes purchased after the effective date, which is November, for homes purchased going forward of $1 million or of $500,000 or more, you have to do a pro rata calculation. We're only going to allow you to take the mortgage interest as if the property costs $500,000. You buy a $3 million piece of property, we're not going to allow you to take the mortgage interest deduction on the $3 million piece of property. It's limited going forward for $500,000. It's kind of like that same issue, right? I buy a house in Pittsburgh for $300,000. I get a deduction for the mortgage interest. Why should Tim get a deduction that's higher than that just because he bought a $1 million piece of property? So it's kind of trying to make a balance with what Americans are paying as far as tax.
Yeah, I think what you're doing, how many people prepare their own tax returns? I assume most of you. And how many people itemize? So everybody knows what we're talking about. I mean, you need to have more than 12,700 in deductions before it's more positive for you to take the itemized route versus the other. But if you're someone that made $300,000 and you have 3.07 PA rate and you have a 1% local rate on your wages, you have $12,000 of local wage, state and local income taxes already. That means you're getting an additional deduction on top of that for your property taxes. You're getting it for your charitable contributions, for your mortgage interest, et cetera. And that gives you a tax benefit, obviously, plus the personal exemptions under the current law. This type of a schematic is fine. It's simplified. It does make things a little cleaner from an overall attribute assessment. I agree. But you know, as soon as they start raising the rates, these aren't coming back. And so you're going to have a complex CPI index adjustment on the 24,000 each year. So it's going to go up 24,800. But when they move the rate from the highest rate from 35 to 37, or they move your rate up from 28 to, or from 25 to 30, it's not going to be the same. And the mechanics of it is going to be a problem. If you could be sure, if you could bet that it was going to stay at these rates for an extended period of time, then this is a good promise for almost everybody from the simplicity point of view at least. But the problem is you get out here. And I'm not sure I agree with Don that in every respect that as a Pennsylvania person paying 3.07 on your gross pay, that we're kind of subsidizing New York. I do agree there's a bigger benefit in a bigger state tax rate state, as Don's pointing out. But look how much trouble Harrisburg's already having. And look how difficult it is to get budgets through the Pennsylvania House and through our Congress to get the governor to sign it. You put all that together, and now you take the federal subsidy away, which is going to be problematic because they're not going to be able to push out increases. When you move that from 3.07 to 3.55, that's going to be a pure gross cost change to every taxpayer in the state, not just the guy making $3 million, but the guy making $28,000 that just got out of school and can't find a job, and he's working at a couple of other jobs. He's making 28 grand. He's going to pay gross that much more without any other further tax benefit. So it's a huge change in thinking from where we've been in the past. And maybe it's necessary. I don't have an objection to it, but understand that it's only this good while the rates are this low.
Yeah, and the next thing, we talked a little bit about the family credit. This is the child tax credit. And I talked about the elimination of the exemptions for your kids, not being able to take that exemption anymore. This family credit, the child tax credit, offsets that to a great degree by increasing it from $1,000 to $1,600. Oops. Go ahead.
I was going to say, you're not going to get that when your income goes over 230, your joint income. It's going to start to be phased out. But understand, most of you should understand already if you're preparing your taxes that currently there are phase-out thresholds for personal exemptions anyway, and I think it starts below that 230 range. So it's not a bad position right now.
And just a couple comments on charitable contributions. The AGI limit is going to be moved from 50 to 60%. And I've got a handful of clients that would affect because they're giving a lot of away, mostly retired people who don't have anybody to pass the money on to, or their kids don't need the money, contributing a lot of money. They're able now to deduct more. It retains the 5-year carryback. And interesting, the last thing is it repeals the charitable deduction. There's a rule out there if you're buying season tickets to a college event, 80% of that can be considered charitable deduction. That's not going to be around anymore. So that's going to hurt a lot of the colleges, a lot of the big schools that have, well, you'd think it would hurt. I don't know if it's actually going to decrease whether people go to those games or not, but you just can't take a tax deduction for it anymore.
Yeah. You know, I wanted to go back one thing. The one thing I've been thinking about with respect to these contributions to charitable organizations for planners and for people that, those of you that have more resources and more capital, is this might be the year, if you see the legislation closing in on finality, that it's going to be the law, and you're not going to get a direct benefit of your charitable contribution. If you're already itemizing in 2017, or your client is itemizing in 2017, might be the year to put $100,000 or $150,000 in a private family foundation, your own foundation, take the whole deduction this year, and you can pay the money out over the next 10 years. So what you've kind of done is you've eliminated the need to take a charitable contribution in those future years anyway. You don't have to give the money to the church or your college or your favorite charity in 2017. You have to give away 5% of the principal in future years. So what you're doing is kind of prepaying it, moving it from your investment accounts where you were going to basically leave it in there to earn money anyway. You can put it in a private foundation, open an account for them, and it's going to earn money, and you're only going to pay out what you would have paid out each year to the charities anyway, and it's under your control. But you get the tax deduction in 2017 when the rates are going to be the highest if this bill moves forward. So it's something I think is worth considering if you have this kind of stomach to add a little complexity to your life.
A couple of other things as far as eliminating certain itemized deductions. This one bothers me a little bit, I mean, as far as eliminating the deduction for medical expenses. I mean, I have very few clients that actually get the medical expense deduction, but for those clients that get the medical expense deduction, it is really important. These are people that are paying a lot of out-of-pocket medical costs. And in a lot of situations, well, you're probably the same boat. It's our elderly clients, right?
Yeah, it is our elderly clients.
It's our elderly clients who are in nursing homes spending a significant amount of money, and it's all medical care. So this is a huge hit for our elder clients.
Yeah, and the people that it hits are those people that live in the Presbyterian homes, the Catholic homes, the retirement communities where a portion of the amount that they pay to live each year, maybe they're paying $30,000, $36,000 a year, $3,000 a month. Well, those people do assessments, and there's revenue rulings out there on reporting what amount of that $36,000 is for medical care, and it turns out to be $20,000, $25,000 in a lot of circumstances that the cost of the care is at least, half, if not more, of the total being paid.
Property and casualty losses are gone, can't deduct those anymore on the individual side. And then fees paid to tax return preparers, us, and investment advisors can no longer be deducted by individuals. You can still deduct them as part of the business on your business returns, but for individuals, you wouldn't be able to deduct those anymore. Most of those are phased out for most of our clients anyway. You never get a deduction for them anyway. A couple other provisions that disappear, the P's limitations, as far as you have itemized deductions and you have to do some funky calculation. You have $100,000 of itemized deductions and only 20% of them actually get deducted. Those P's limitations disappear, which makes sense because, remember, going forward, the only itemized deductions you're going to get are property taxes, limited to $10,000, mortgage interest on your principal residence, and charitable deductions. I mean, those are already significantly limited as compared to where things are today. So we don't need the P's limitations anymore. The complete repeal of the alternative minimum tax. And we should all be cheering. The alimony deduction is gone.
That doesn't mean you won't have to hear Don next year. Even with no AMT, he'll still have to talk.
I should have a slide going forward every year just to remember. The alimony deduction is gone, which is kind of interesting. There's a big benefit to that alimony deduction if you're paying the alimony. If you're collecting the alimony, you have to report it as taxable income, which you wouldn't have to do anymore, which is kind of interesting. And a lot of people were playing the game, paying that alimony to get a bigger tax deduction for the asset spouse who has more money and higher taxable income, reducing taxable income at a higher rate, and with a spouse who's collecting the alimony, paying tax at a much, much lower rate.
It is interesting, though. I think at the end of the day, that's going to change the alimony payment schemes. We can do the same thing we're doing now after the law passes. We're just going to pay less alimony by the moneyed partner. So if she's the earner and she has to pay the husband alimony going forward, we're going to probably pay less to balance out what the tax effect is anyway. And so we'll take care of that backdoor-wise. Melissa and I do a lot of that type of work, and that's the kind of thing that I'm sure she'll be advising people.
One of the first presentations I ever did as an employee of Grossman, Yanak and Ford was about 312 years ago when Bob and I first started speaking together. And one of the things Bob said, he was quoting one of his attorneys as far as divorce is concerned. Divorce, love is grand. Bob?
Yeah, divorce is 20 grand.
Yeah, love is grand, divorce is 20 grand.
Yeah. I'm on the board at my church, and the pastor's always talking about how busy he is on Saturdays marrying people, and I'm like, you keep marrying them, we'll keep helping them get divorced 24 months down the road. He hates to hear that, let me tell you.
The exclusion for the dependent care assistant program, this is the $5,000 you set aside so you can send your kids to daycare if you're working. This was actually pulled out of the law 2 days ago. So when we put this, actually it was yesterday.
Yeah, yesterday.
It was yesterday. This was originally in the slides and it got eliminated yesterday, so you can ignore that one. An exclusion for the gain on the sale of personal residence. And this is for anybody who has a gain on a personal residence on your home that's over $500,000. For most part, there are very few people in Pittsburgh selling homes.
In our region.
I don't know if I've ever had that. I've had a client. I don't know if you have. It's very rare. But those rules have been changed. I don't even want to talk about this one because it's horrible, so I don't even want to address it.
Well, there's a lot. They took away the deduction for adoption expenses, but it's, I understand, going to be reinstated as well.
Yeah, I can't imagine that one gets through.
Yeah,
that's why I kind of just blew over it. So I have a little example for you here. It's a current law example, just to point out a couple things I thought were important. So let's assume my compensation is $150,000. My wife works. She makes about $10,000. She works part-time. I live in Pennsylvania. Pay state and local income taxes of $4,000. I have a $300,000 house in North Hills, Pittsburgh. My property taxes are $10,000 a year. My mortgage interest on that $300,000 mortgage, $300,000 home is $10,000. Currently I have 2 exemptions. I don't have any kids. So my taxable income is $127,900. I'm sorry, yeah. And my tax under 2017 law is about $23,453. Okay, let's assume Bob. Bob's in a similar boat to me, except we both make the same. He makes $150,000. His wife works. They put their kid in daycare, so they get the $5,000 deduction because they put their kid in daycare. So that reduces his taxable income. Bob lives in New York City. Lives in a place about the size of the bathroom, but it still costs $300,000. And because he lives in New York City, his taxes are twice. His income taxes are twice what I pay. So his are $8,000, mine are $4,000. His property taxes. Bob has a home in New York City that he lives in, a small little apartment. It's a condo that he owns. And he also, since he hates New York City, even though he lives there, he still hates New York City. And he has a place down in Hilton Head, a $300,000 house down in Hilton Head. So you put the New York City property taxes, add them to the Hilton Head property taxes, he gets a deduction for $20,000. He has mortgage interest on his New York property of $10,000, and he has mortgage interest on his Hilton Head property of $10,000. And he has 3 kids, so total exemptions of $20,250. Bob's taxable income is $86,750. His tax is $13,000. He gets child tax credit of $3,000. So at the end of the day, I pay $13,000 more in income tax than Bob does. Does anybody think that is fair?
What did President Trump say about the Chinese today? Don't blame them. They're smart, but we're stupid. And that's what I would say there. Don't blame me. You're living in Hicksville, and I'm in New York and Hilton Head. I just have better tax advisors than you.
So, I look at this and I say, boy, there's something very unfair about this. Now, I have no problem with the deductions he gets for the children, right? The exemptions and the child tax credit. He should. But at the end of the day, why is he getting a bigger tax deduction for his property taxes? He has a place in Hilton Head, and I'm helping him pay for it because I'm paying more taxes than he is. He's paying mortgage interest on his Hilton Head property. And I'm funding that. I look at this as being a little bit unfair. Not a little bit. That's very unfair. I'm funding your vacation home.
You should be. The counter argument to that certain people would make is that you are basically spending more money in those jurisdictions. You created more jobs by having 2 properties, etc. But the one place that the Democrats really struggle is the idea that I have 3 exemptions, he has 0 exemptions, and that I shouldn't be getting a benefit for having more children. That's another concept that's kind of ingrained in American taxation, that we should be subsidizing people that are having a lot of children. And it's almost, I'm not going to say people shouldn't have children. That's not a good statement to be making up here. I don't think that's politically correct. But I think there's an underlying idea that we should be helping younger families with younger children, no matter how many children they have. And that's a precept that follows through a little bit in the new law, but is considerably different than the old law.
Yeah, I mean, there's significant. I mean, if you think about where this is here, and I showed this as an example because I wanted to show you where we end up in 2018. So based upon what we talked about, let's think about 2018 under the new tax law. Under new tax law, the state and local tax deductions, neither one of us get a deduction for that. It's gone. The property taxes, limited to $10,000, so I would get that. Bob, his $20,000, he doesn't get $20,000 deduction anymore. He only gets $10,000. Mortgage interest, only on your principal residence. So mine is $10,000, Bob's is $10,000. And the exemptions are gone. So my tax consequences in 2018, at the end of the day, I now use the standard deduction, $24,000. So my total tax is $22,300. Before it was $23,000. I'm actually saving money here. I actually have more money to put in my pocket than I did before as a result of the tax law. Bob's going to take a serious kick in the backside, right? So what happens for Bob is he loses about $40,000 of deductions. He still benefits from the children because of the child tax credit. But at the end of the day, my tax went down by $1,100. Bob's went up by $6,000 under this law. Wow, that's a big difference, right? And the reason it went up, like I said, the mortgage interest reduced, only on the principal residence. It's his option to have the vacation home. Property taxes, it's his option to have the vacation home.
Go back to the facts again. I mean, this is a very simple illustration that Don put together, but if you look at it, even in my column, in the Bob column, there really is not that extreme of numbers. So you can see that somebody that's making 150 or 200, a couple, you know, a young professional couple making 200,000 with 3 kids. I mean, it would be easy to line those up even without making jokes about New York and Hilton Head to have, you know, state and local taxes of $8,000. That's not that extreme. Property taxes of $20,000. If you live in Upper St. Clair or Sewickley in a nice house that costs a couple $100,000, maybe $300,000 or $400,000, you could end up with that. If you have that $300,000 or $400,000 house with a $300,000 mortgage, you're going to have 20 in interest. So it's not as far-fetched as it seems to reach out of that jurisdictional reach of the bigger cities to Pennsylvania. I mean, it's going to have an odd effect, and it's radically different from the law that we've had in place for a long time.
It is incredibly different. And the point being here that, boy, there's a very big difference between two, we'll call them middle income taxpayers, right? There's a very big difference. One of them saves $1,100, the other saves $6,000. It's a very, very big difference. So let's assume that this map is, you know, let's assume this map is...
This isn't statute. This is Don's theory from working too much.
So let's assume this is a map of who's going to benefit and who's going to struggle on the individual side as a result of this tax law. So we're losing our property taxes, right? The property taxes are limited. Let's look at the blue states. Illinois, very high property taxes. California, very high property taxes. New York City, very high property taxes. Virginia, very high property taxes. They're losing a lot of their property tax deduction. How about the income tax? Where are the highest income tax rates? California, right? New York, Connecticut, Minnesota, Illinois. So those to me, looks like those are the states that are going to suffer. Those are the citizens of those states are going to suffer the most because they're losing their state tax deductions, the SALT deductions as we call them. Now let's change the thinking and say, you know what, this isn't really a map that I put together for income tax. This is how the country voted last year. This is the electoral college.
It's a conspiracy.
Yeah, and it's very interesting, right? You say, who's suffering the most from this? You look at the electoral college vote. Trump won the red states. Lee lost the blue states. Isn't that interesting? When you think about it that way, and I don't think conspiracy, but it's just very interesting that you look at the states who are going to suffer dramatically. Trump, as Timmy just said, Trump is vindictive.
Yeah.
It may not have anything to do with how this is being passed, but it's just quite interesting in my mind. And this is why I can't sleep at night.
I know. Yeah, you need to take some aspirin and get some rest, I think. The other thing I would tell you about this is understand, again, you have to have $24,000. You have to have more than $24,000 now to make itemizing worthwhile, right? Because they moved the standard deduction up. The home mortgage interest has been preserved for most of us, and Don talked about that. But understand the mechanical calculations, even under current law, favor certain groups. The average cost of a house in Pennsylvania is $166,000. The average salary statewide across the whole state is $60,000. So the prior law, the 17 law that's in effect at the current time and will in fact be the law for the 2017 tax filing season in the spring, requires a house of about $300,000 with a $250,000 mortgage, generally under average circumstances, to make itemizing worthwhile. Under the new law, moving the standard deduction all the way up, you're talking about an $800,000 house and a $700,000 mortgage before itemizing is going to be useful from the venue of just mortgage interest and the real estate taxes on that house. So while they preserve the mortgage interest deduction under this legislation, its usefulness and its meaningfulness, if you will, becomes almost nil. And the average house for most of the people that we know is not an $800,000 house with a $700,000 mortgage with a $25,000 a year or $20,000 real estate cost that'll get capped at 10 anyway. So, I mean, that's the thing to look at. This is the closest that we've ever had in my career, starting in 1980, of getting rid of the mortgage interest deduction, because it is still there, but it's going to have almost zero relevancy going forward for Pennsylvania taxpayers.
Yeah, the major piece of simplicity here is 90% of Americans don't need to itemize anymore. That's where the simplicity comes into play.
Yeah, it puts you back to the postcard again.
Right back to the gigantic
postcard. Okay, we'll just have to start taking child care credits for your dog. On the estate tax side, remember that the framework advised and what they really wanted to try to do was repeal the estate tax. That's been a mantra for the Republican Party forever. Not so long ago, I mean, well after Dawn started and Melissa started, we did a lot of estate tax valuations. The exemption was only $600,000.
That was only about 10 years ago, I think.
Yeah, now it's, I mean, $5,430,000 being inflation adjusted. So a couple has nearly $11 million of property they can transfer at death without the imposition of any estate tax. So that's an interesting trade-off, because while this bill does not repeal the law immediately, it proposes to repeal the law in 2024. In the meantime, immediately, which I assume to be January 1st of 18, they're going to put in effect a doubling of that exemption amount so that couples will have a state tax at $22 million before the death taxes start to get invoked at all. So that's a big change. There are few, very few estates, as you can imagine, that are over that $22 million threshold. And so the estate tax will almost become obsolete and less relevant in itself. The point being, the reason this was changed in the House bill, what you read in the scuttlebutt from the House reports and so forth, is that the Senate doesn't want to repeal the estate tax. The Senate elections are much more at risk than the House control next year. And they think getting rid of the estate tax looks like a favoring move for the wealthy, and so they want to keep it in the law. Now, the Senate bill's not been released today yet that we know of, and so the thought is, you know, when it comes out, it's going to include something different than total repeal of the estate tax. But this is a concession, an early concession by Ways and Means to match up with the Senate bill to move things faster. And at doubling the amount, I don't think they have to do any more at the end of the day. I would suspect that this provision will pass being increased somewhere between 11 million and 22 million at the end of the day.
Yeah, I personally hate the fact that they're changing estate tax planning going forward. I mean, I'm okay with the changes, but for estate tax planning, you need to make it effective today, because what happens is that, like, all of a sudden, you know, the difference between December 31st, where you have a $5 million exemption, and January 1st, where you have a $10 million exemption, I just hate to think about the planning that go along with that at the end of one's life. It's horrible to even consider that, and you know it's going to happen at some point if you know that it's coming and it's going to happen on January 1st.
Yeah, there are two additional taxes integrated into the estate tax schemes within the Internal Revenue Code. First one is the generation skipping tax, and then the other is the gift tax, which is applicable to inter-vivus transfers during one's lifetime. They're not getting rid of the gift tax, just the estate tax. And it's kind of interesting because I look at them as being one and the same, because after '86, I believe, they did everything through unified credits and kind of looked at it as one and the same. We're going to separate it again, and we're going to preserve the gift tax. So that makes planning different than what it's been, because lifetime transfers aren't going to be as popular. If there's no death tax at the end when you die, then why gift it now at the current time? And there are basis considerations as well, meaning that at death, and we don't know the answer to this, but Dawn, was doing some looking. We're trying to run it down. It looks like even though they're talking about doubling the framework or doubling the lifetime exclusion to $22 million, they're still going to allow for the step up of the basis under 1014, meaning that if your parents have a home and the home's worth $500,000, but your dad paid $20,000 for it 40 years ago, he dies, the heirs get that property at $500,000. So if they sell it the next day, there's no further gain or loss on the sale of that property. And his estate is taxed at $500,000, but he's covered by the exclusion. So he pays no death tax and you get the step up. So it's going to promote the idea that you're going to hold on to everything until death, because gifting, you don't get a basis step up. And so the only thing the law provides for right now is changing the tax rate, lowering it to 35%, but not for 6 years until 2023. So there's a lot of talk about that. I think the lack of favorability with respect to wealthy people in estate tax is going to prevent that from being completely repealed. There's been a lot of talk about 401ks being stopped, that there were going to be no more deductions for contributions into 401k plans and everything would work effectively like a Roth 401k. The president said that would stand. About 2 weeks ago, the House Ways and Means Committee kept saying, it just depends. We need revenue raisers to offset the cuts. At the end of the day, it did stand, and he's letting IRAs and 401k plans that we traditionally use, most of us, to stay in place as it is. It does repeal the rule, though, allowing taxpayers to recharacterize Roth contributions after the fact as traditional IRA contributions. And it also repeals the rule allowing taxpayers to convert a traditional IRA to a Roth IRA. And that's something that's been a popular move by planners in certain circumstances. You have someone that has a very significant estate. Someone's got to pay income tax on that at some point anyway. So if you pay the tax on the Roth IRA right now, deplete the estate to some degree, get the monies out, and basically move it forward in a Roth fashion. And then it modifies a number of other rules, including the hardship distribution rules as well. On the business side, real quickly, there's not as many changes, interestingly, to the business taxes that are really major, like the individual tax regime, but it does make a lot of these changes. As I said, the industrialized world's average tax rate is 22.5. Right now, we're going to have a flat 20% corporate tax rate. You'll understand that there's a, I must have taken that out. There's a graduated rate, here it is. The corporate rates under the current law, 0 to 50,000 is taxed at 15 under the current law, 25% on the next $25,000 block. Then on the next 25,000 under current law, it's taxed at 34, and then between 100,000 and where we're at, it recaptures part of that. So it recaptures the benefit of the 15 and 25% brackets up around 330, 340 of corporate income. All of those rate differentials are going to fall out. It's just going to be a flat 20% now going forward. Small business pass-through is something that's near and dear to Dawn and my heart, and we've spent a lot of time looking at this. For a long time, there's been this issue that corporations get these deductions, they get a tax rate maximum 35%, but individuals at lower thresholds end up paying tax at 39.6%. And so a business organized as an S corporation has certain tax advantages when you sell assets at the end of the road, but in the course of operating the business, there's an arbitrage where it's costing you more money to maintain S corporation status than C corporation. I explained that at the beginning of the conversation, and that's really a commonality through a lot of smaller privately held or family-owned businesses, is this pass-through regime being taxed at 39.6. They've changed this with the idea that if a regular corporation is going to be taxed at 20%, then these pass-through businesses, which are creating at least as many jobs as C corporations in the U.S. economy, should enjoy a lower tax rate. And so they cap that business rate at 25%. Sounds pretty simple. Dawn and I knew from the beginning that there would be two issues that are going to make this exceedingly complex, and it's worked out that way. And that issue is primarily that how much of the income from your interest in a partnership or an S corporation is attributable to labor, to salaries paid for personal services rendered, and how much of it is a return on investment. because the IRS, or excuse me, the House in this bill, the part that's subject to labor, you know, you earn $300,000 in a pass-through business entity, and the value of your services are $300,000. Their position is that's all personal earned income, and that should be subject to the highest rate. Now, given those numbers, it'll be 35% under the new law, not 39.6, but it'll be 35, not 25. On the flip side, the return on investment, if your salary in that illustration is only $100,000, and that's fair, theoretically, $200,000 of that income would flow through at 25%. A good example is we have a client in the distribution industries who passes through about $15 million to 5 shareholders, a senior family member and 4 siblings. So they move $15 million out. The people that are in the business get paid exceedingly well, you know, so somewhere between $500 and $1 million a year. So the other piece that passes through after the deduction of those wages is $13 or $14 million. The question is, should that whole 13 or 14 be subject to 25%? I'd say that's exactly how Dawn and I thought it was going to be until the law came out, but they obviously see it differently. And so what's going to happen under this law is they're going to look at each particular owner, and each owner is going to separately determine his or her proportion of the pass-through income that constitutes a return for labor and a return on investment. And that makes, I mean, it's logical to me that you should pay tax rates applicable to labor for labor services, but then the question is going to be how to determine that. Well, the passive activity owner, and everybody's familiar with passive activities in Code Section 469 added by the 86 Tax Reform Act. That's pretty cut and dry legislation now. It's 40 years old, and it's really 30 years old, I guess, and it's really well established through a lot of rulings, a lot of regulations, what that is. So in the example I just gave, if one of the daughters is not involved in the business but gets an allocation of $2 million of corporate income, she is a passive investor. All of that income is going to be subject to 25% income rate change. Big deal, because before it's subject to 40. And so ultimately, there's a 15% savings on that. That's pure cash flow to the corporation. It doesn't have to be distributed. Alternatively, the active owners, the people that stay in the business, the daughters and sons that stay, some proportion of their income has to be deemed a return for labor for the personal services rendered. And so that has to be done on what they call in these rules a capital percentage calculation. Now, the capital percentage calculation can be a little extreme, but what they're really looking at is safe harbor percentages where 70% is deemed to be comp and 30% is to be business income. That's kind of odd. So they're saying somebody has $1 million flow through, $700,000 salary, 30 return on investment. That's a fixed percentage. It's not going to be applicable in most cases, and where it isn't, there's an alternative to the safe harbor, and basically you can use a formula based on facts and circumstances. And that's where the bills come in for the accounting firms, because you're going to have to measure the capital percentage based upon rates of return, and they're talking about an adjusted rate of return of the applicable federal short-term rate plus 7 points. What happens if you have a really super well-run company, and why can't you get a 30% return? And that's the real economic return. So what's going to happen is we're going to end up fighting a lot unless they have really clarifying rules on reasonable compensation and what really equates to reasonable compensation in a privately held enterprise. Because you can't measure return on investment. Return on investment is the gross minus the amount for reasonable comp. So it's going to be reasonable comp arguments as well. Changes to the expensing provisions in the time we have left. 179, they changed the expensing cap to $5 million from the current $500,000, meaning that under 179, used or new equipment, you can expense first year $5 million. And there's a 20 million threshold that used to be 2 million, so they've increased the threshold significantly. So substantially larger companies will get to expense their capital expenditures, and meant by design to promote businesses investing in additional equipment to add jobs. That's what that's all about, and it makes perfect sense. There's a lot of changes in the accounting methods. I'll just go through them real quick. Accounting methods can be a real nuanced type planning mechanism, but under the cash method of accounting, which is a preferable method in a lot of businesses, basically paying tax on cash in minus cash out for expenses, it expands the companies that can use that by increasing the cap from 5 million on average gross receipts to 25 million. That also applies to partnerships with a corporate partner. Inventories, even if a business has inventories, current rules provide that if inventories are a materially important aspect to the determination of fair presentation of taxable income, then you have to use an accrual basis. They're saying even if you have inventories, as long as you have 25 million or less in average gross receipts, you too will be able to use cash method of accounting. Big change. No legislative language on how you make the conversion from accrual to cash if it helps you, but it'll be something we have to look at. 263A, another super cost capitalization thing, which basically incorporates the ideas of throwing a lot of overhead costs into inventory at the end of the year for taxes, not for GAAP, thereby lowering your cost of sales and increasing your taxable income. As long as you have 25 million or less in average gross receipts, that provision is going to be repealed. Long-term contracts, the same thing. They're moving the threshold up to use completed contract method accounting or other permissible methods from 10 to 25. So more companies are going to have more lucrative issues there. And the last thing I want to talk about, and I'll take some questions, is, well, the NOLs too, is this business interest. If you have gross receipts of 25 million or less, then these interest limitation rules won't apply. But if you do, then the interest deduction is disallowed for amounts in excess of 30% of the business's adjusted gross income. So it's working like a C corporation calculation works with charitable contributions. There's an income threshold that's determined the adjusted taxable income without consideration of the interest deduction times 30%. That's the cap on the interest you can deduct. And the interest you can't deduct under the House bill, you'll get to carry forward for 5 years before it's law.
That's pretty interesting. I mean, that's a pretty good benefit for a lot of our small, middle-sized clients, that $25 million threshold. Because initially we had no idea there was going to be a threshold. And that would have been a real pain for your $5 million company that borrows money and they can't take the interest deduction. But the rule came out that for now they're looking at $25 million and below or aren't going to have that limitation.
Yeah. On the net operating loss side, they're either carried back or forward, carried back with extreme limitation. For all intents and purposes, carrybacks have been eliminated in this rule. There is a very specific exception in there. They're only carried forward to the extent of 90% of the taxpayer's taxable income. So no longer will you be able to offset 100% of your income with your net operating loss carried forward. That's a big change. And it will apply effective, no matter when the bill is signed, to losses incurred in calendar 2017. This change I find to be really interesting is gross income of a corporation is now going to include contributions to capital to the extent of the money and the fair market value of the property contributed exceeds the fair market value of the stock or equity instrument received in exchange. Generally, capital contributions have always been tax-free, a non-taxable transaction. The issue with this is going to be determination of the fair market value of the stock or equity issued in exchange. Because the reality is the assumption is always that, we gave you $100,000 of cash, we got $100,000 of stock in return. So I'm not sure how broadly that will be interpreted, but that's a big deal when they start taxing capital contributions in any respect, because it's sure to be modified over the years. Non-qualified deferred comp is going to go away. As soon as a substantial risk of forfeiture lapses, those non-qualified amounts are going to be taxable. So even if the recipient of the non-qualified deferred plan hasn't gotten the money, it's going to become taxable at that point. So it's going to change the structure of non-qualified deferred comp plans. And finally, some of the repealed provisions that are here. 1031 like-kind exchanges excepting for real property are going to be terminated. Technical termination of a partnership under Section 708B1 is being eliminated. I have no idea why.
I don't know why it's there in the first place.
It's so specific. The lobbying deduction for locals, lobbying is rarely deductible, but if you're some kind of real estate developer or something and you're lobbying the local gurus at the Office of Deeds or whatever, that was deductible in the past as part of a business expense, no longer. We talked about the domestic production activities income. The entertainment expenses are deductible only 50% under the current law. That's repealed and they won't be deductible at all.
So next year we won't have penguin tickets to give away at the end of the day.
Yeah. Repeal of certain credits. The employer provided child tax credit, that's the one they put back, right?
Yeah, that's
Yeah,
fine.
Jay just put that back last night. The rehabilitation tax credit, the work opportunity tax credit, the new markets tax credit, all terminated. So that's really where the law is. Prognosis, or what's the passage?
It'll be passed, but it'll be late December. That's my guess.
Yeah, I think the thought process is that, again, it's now all a political thing. So it's out of the hands of sanity. And so the reality is the Republicans have to get a win. They lost the 2 governorships Tuesday. They couldn't get Obamacare repealed. The guy looks like a nut with all his tweets. I mean, if they don't get a win here, then they're going to have a hard time holding the Senate next year for sure. And I think they all feel that, they sense that, and I think as a group, the members of Congress are going to push this through. It doesn't matter what anybody thinks, it's going to go through. So I would be really surprised if we didn't have this legislation signed by mid-December to late December, and that most of it is going to be effective in January 1st. I think that's where it's at. I don't know if we can answer any questions in a minute or two we have left. We're very close, but we'll be glad to answer any questions you have. Otherwise, we'll be around here. You can ask Don any questions, and he'll be glad to answer them at your convenience. All right, we're on break. Watch the clock. We'll get started on the last session. Thank you.